Welcome to our mid-year fixed income outlook for 2023. Following the worst year for bond markets in 2022, we saw a bounce back of performance in the fixed income markets since the start of the year, with high yield performing over 5%, outperforming treasury bonds and investment grade corporate bonds. We also saw emerging market bonds delivering very strong returns, especially in the local currency space. In a year of transition, we expected a lot of disruptions, and the first half of the year was exactly that. We had a US regional banking crisis. We also had some European banking turmoil with Credit Suisse takeover from UBS. We also had the continuation of the war in Ukraine and very weak China macro data. And don't forget, we also had the whole debate around the debt ceiling in the United States. What surprised market participants in the first half of the year is just how resilient the economy has been. We had extremely strong employment data, especially in the second quarter of the year. So in this environment, for the second half of 2023, we expect growth to slowly decelerate and get into a below trend growth level for the rest of the year as well as 2024. We expect US GDP growth to be 0.8% by the end of the year. We also expect inflation to remain very high. Inflation has already come down if I look at goods inflation, but services inflation is still very sticky. So inflation is expected to be 3.8% in the US for the rest of the year, which is well above the 2% target from the Federal Reserve. In this environment, we expect central banks to keep interest rates higher for longer. We expect the Fed to hike at least one more time in July this year and potentially a second time toward the end of the year. In this environment, we expect 10-year Treasury yields to be around 4%. With regard to credit markets, we like both investment grade and high yield. The fundamentals of credit markets are very strong. We're seeing a lot of high yield companies being upgraded more than those being downgraded. We're seeing companies with very high interest coverage as well as very low net leverage. So default rates will slightly increase to 4 to 5% over the next 12 months, but we believe the yield on offer in the market today overcompensate for the risk you're taking. In summary, investment strategy for the second half of the year can be defined by two words: be prudent and opportunistic. Be prudent by keeping assets in defensive fixed income assets such as treasuries, keep some duration in the portfolio, but also be opportunistic in order to take advantage of market dislocations by investing in high yield investment grade corporates as well as emerging market debt bonds. Thank you for watching and see you next time.